Hi everyone and welcome to Financial Fit Check, How to Start Investing. My name is Mia Sampson and I'm the manager of the marketing and social media department at Gerber Kawasaki Wealth and Investment Management. While we're a smaller firm in Los Angeles, we serve clients across the globe and focus on educating our clients while putting together their plans. What sets us apart and makes us unique from other firms is that we will work with you at any stage of your life. So most financial institutions require high minimums for help investing, but we'll work with you before you have that capital and help you get there. Investing hasn't always been a hot topic, but it really boomed in the pandemic. I think that a big reason for that is that a lot of individuals had unexpected stress put on their financial situation due to business closures and massive layoffs. It was a rude awakening for many that having financial security is something that we should all strive for. So today, I want to talk about first, why investing is key to financial security, 2, the differences in attitudes and returns for females and male investors, 3, how to get started investing and how to find a financial professional that's right for you. Men and women tend to have varied views when it comes to investing and managing money in general. Only 26% of women in the US currently have money in the stock market. Now, this is probably partially due to the gender pay gap. Having more money to invest leads to greater wealth accumulation and interest in the markets, which is more difficult when women are making 82 cents for every dollar that a man earns. This brings me to the first point that I really want to discuss, which is why investing is key to financial security. A big barrier to investing is the fear that it's risky. But by saving your money in the bank, your interest rate is probably barely keeping up with inflation. If you're not keeping up with inflation, then your hard-earned money is actually going down in value. Once you begin to routinely save through an investment account, you start to earn interest on the principal amount that you invested. And then from there, you begin to earn interest on that interest, and then again, and again. So each time you're earning interest on the interest, it's growing exponentially. This is called compounding interest, and it allows your money to work for you. Apart from being able to create additional revenue streams and beat inflation, investing can provide tax advantages for certain types of savings accounts. Some examples of this would be a Roth IRA, HSAs, which are health savings accounts, 529s, which are used for college savings accounts, and many more. Lastly, it gives you the opportunity to participate in companies that you believe are shaping the future. When you own stock in a company, you're part owner in that corporation. And if it's renewable energy that you believe will shape the future and combat climate change, then you can invest in companies that are leading in that space. With the pandemic and an aging population, we've seen rapid advancement in biotechnology. You could be investing in that. Technology, although we hate it sometimes, we all hate social media sometimes, we can't deny that it has connected us to old classmates, relatives, colleagues in ways that weren't possible before. Work from home and school from home wouldn't have been possible if technology wasn't where it's at today. And you can be a part of these movements by investing in the areas that you believe in. Let's move on and talk about our second point. What are some of the differences in attitudes and returns between female and male investors? Apart from there being fewer women investing in the stock market than men, when they do choose to invest, they tend to have more conservative portfolios. As mentioned before, creating a portfolio that can outpace inflation is essential. Of course, you should still be looking at your overall goals and discussing what balance of risk to reward you're willing to take on with your financial advisor. Having more conservative investments is not always a bad thing. In a study done by FINRA, researchers found that 71% of men assess themselves as having a high level of investment knowledge compared to 54% of women. Even though men's confidence levels are much higher, women tend to have better investment returns. It's very difficult to take emotions out of investing. You're seeing your hard-earned money fluctuate. The stock market is a volatile place, and it's instinct and impulse to react to any movement of money. At Gerber Kawasaki in particular, we focus on investing in companies that we see being leaders for the next 10 plus years. By focusing on short-term fluctuations, you can greatly hinder your ability to make money. In the last 10 years, from 2010 to 2020, the S&P 500, which is a stock market index of the 500 largest companies in the US, has had an average return of 13.6%. But if you miss some of the biggest moving days, your returns could be significantly lower. This is something that women have going for them. We are patient. Wells Fargo found that women trade 27% less frequently than men. When using the robo-advisor Betterment, women changed their asset allocation 20% less frequently than men, and Vanguard accounts found that women were trading 40% less frequently than men. JP Morgan put out more studies about this dating even farther back. So they took 20 years between January 4th, 1999 to December 31st, 2018 and said, okay, if you invested $10,000 in 1999 and never took your money out, you would have $29,845. But if you got nervous and did not stay invested the whole time and missed the 10 best days, and think about this, the 10 best days out of 7,300 days, your money would be worth $14,895. That's about half of what it would be if you stayed invested the whole time. So that's why we always say it's not about timing the market, it's about time in the market. So how do you get started investing and how do you choose a financial professional? Investing in mutual funds and exchange-traded funds, or ETFs, is a popular method commonly used to invest in stocks and bonds. A mutual fund pools investors' money together for a common objective like growth or income. An ETF is an investment that tracks a basket of assets like a market index or a sector like solar or pets. You don't necessarily have to pick the winning company when you're investing in an ETF, but rather the winning sector. We've seen a large trend and adoption of solar energy, but it was hard to tell at first what company would really accelerate moving forward. The ETF TAN allowed us to track the top solar companies and have positions in all of them. One strategy that many investors use is called dollar cost averaging. This is a strategy that takes advantage of the fluctuations of the market by buying more shares as the price drops. You can do this by paying yourself first. Say on the first of the month, I'm going to put X amount into my investment account. Some months it will buy you more than others. So let's look at an example of how dollar cost averaging works. When you're dollar cost averaging, you're making a regular contribution that goes into your investment or retirement account at the same time each month or each week, however you want it to be. If you have a 401k, it's actually really similar to probably how you're investing in your 401k. But let's look at an example of how this works. Okay, so in this example, and please remember that this is indeed a hypothetical example, we have two people. We're going to call them P1 and P2. Person 1 and person 2. And person 1 is going to be investing in this rising market here, versus person 2 is going to be investing in this fluctuating market. They're each going to be putting in $500 a month. And excuse my handwriting if it gets a little bit messy. They're each putting in $500 a month. And we're going to see how their stocks do and who wins at the end of the 6-month period. So, to start out, person 1 and person 2, both of their stocks are at $5. So, with their $500, each of them can buy, well, 100 shares. Second month is where we start to get a little bit different. So person 1 now, theirs is going up. Okay, they're now at $6. So with their $500 and the shares being $6 each, they can get 83.33 shares. Person 2, on the other hand, theirs went down. It went down to $4. Now with that $4, and remember they're investing $500, they can buy 125 shares. Person 1 keeps climbing. All right, so now they are at $7. With their $500 and the shares being $7 each, that means that they can buy 71.43 shares. Person 2, theirs just keeps going down. So theirs went down to $2. With their $500 and the shares being $2 each, they can get 250 shares. Person 1, this stock is just doing so well. It just continues to go up. Now at $8. With their $500, that gets them 62.5 shares. Person 2, finally, it's about time that this one went up a little bit. Now, we are here at $4. So that's the same as before, 125 shares for their $500. It is now, what, month 5? Yep, we're on month 5. So person 1, theirs is now worth $9. With their $500 and it being $9 per share, they can now get 55.56 shares. Person 2, it went down again. It seemed like it was going so well. It went down again. It's now $3, which with their 500 gets them 166.67 shares. We're in the last month here. We're about to see who won. Person 1, theirs all the way at $10. Theirs doubled. Okay, so theirs is at $10. They're putting in 500, which means that they can get 50 shares. Person 2, they're right where we started. So they're at $5, which gets them 100 shares. Let's total it up and see how many shares each person has and what those are worth. So person 1 has a total of 422.82 shares. Person 2 has a total of 866.67 shares. But we don't stop there because remember, each of these are worth something different. So person 1, their 422.82 shares are worth this $10 amount. So multiply it by 10, we're at $4,228.20 as their total. That's what all of their shares are worth. Now for person 2, theirs are worth this $5, which is what it started at. But with their 866.67 shares times $5, they get a total of $4,333.33. It's a lot of threes. So actually, even though person 2 stock stayed at the same price that it was at the beginning after the 6 month, they ended up with more money than person 1. And that's exactly how dollar cost averaging takes advantages of the fluctuation in the market. So you shouldn't be worried about these short-term fluctuations when you're putting in money consistently because you could actually end up with more. A lot of people fail to save because they use their income for their fixed monthly expenses and then they tend to overspend on miscellaneous activities or items such as shopping or going out to eat. Now, paying yourself first uses the out of sight, out of mind strategy. You save first a reasonable amount that still allows you to pay for the things that you need, like rent and insurance, and then everything that's left over is there for you to use. When you work with a financial advisor, the goal is to review your financial situation and create a plan to achieve whatever goals you have, whether it be buying a house or going on extravagant vacations or retiring someday. Your financial advisor should be viewed as the quarterback of your financial life. Rather than looking at one of those specific areas, they're making sure that your overall financial picture is in order. You should also be looking to work with a fiduciary. A fiduciary is a person or organization that is bound legally and ethically to act in the client's best interest. Fiduciaries have to disclose conflicts of interest and tend to be overall more transparent. They're held to a higher standard than just working off client suitability. So before I end here, know that it's never too late to start investing. Time is your friend, and like I've said already, it's not about timing the market, it's about time in the market. If you're just starting out your career and starting to build your wealth, you can also start investing. You have a long time horizon, and investing is not just for if you're already wealthy. If you're established in your career and nearing retirement, it's extremely beneficial to sit down with a financial advisor and ensure that you're ready for that large monetary change. I would really like to thank The Wrap for allowing me the opportunity to present to all of you watching why you should be investing and how you can get started. I hope that while this was educational, it was also interesting and that you feel empowered to join either the world of finance or to take control of your finances and know that I'm here, Gerber Kawasaki is here, to support you and your goals and your financial journey. Don't hesitate to reach out. My email is mia@gerberkawasaki.com, or you can call using 310-441-9393. Let's all stay connected. I'm on TikTok under Markets with Mia, and I also do a weekly podcast that's on YouTube, Spotify, and Apple Podcasts with my coworker Ziad called How To with Mia and Ziad. So slide into my DMs any day and we can talk more about investing. And with that, thank you for joining me on my first ever masterclass.